Welcome back. I'm Jeremy Szafron. We're tracking a market wrestling with a trio of powerful cross currents this morning. Now, stock futures are wavering, the dollar is showing strength, and the 10-year Treasury yield is holding at around 4.1%. Gold fighting to reclaim that psychologically important $4,000 level after being knocked down. Now, this market indecision is a direct reflection of major events of the last 24 hours. First, the Federal Reserve cut its key interest rates by 1/4 point, yet Chair Jerome Powell immediately threw cold water on the idea of more cuts to come. Take a listen.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
All right, a bit of a hawkish tone there. And second, of course, the U.S. and China have declared a fragile one-year truce in their trade war, a deal with huge implications for everything from rare earth minerals to soybeans, which they continued to purchase just of yesterday. Now, all of this happening in what Powell calls himself in the fog, a government data blackout that's left policymakers flying blind. And of course, inflation remains stuck at 3%. The federal deficit is near $1.8 trillion, leaving the Fed caught between price pressure and a mountain of debt. Now, to get the analysis you won't hear anywhere else, we're joined by Dr. E.J. Antoni. He's a chief economist at the Heritage Foundation, was President Trump's nominee to lead that Bureau of Labor Statistics, the very agency at the center of the blackout here in terms of data. Great to see you, E.J. It's essential to have your voice here today.
Well, thank you for having me. It's great to be back.
We got to start with that hawkish warning. I mean, we had a rate cut paired with him sounding a little hawkish. I mean, the Fed also announced a hard stop to its balance sheet reduction, what we call quantitative tightening, effective December 1st. I mean, what's the real story here? Is this a central bank in control, or is it cornered, forced to kind of provide liquidity to a fragile banking system while projecting this tough stance on inflation? What are your thoughts?
Well, this is a Fed chair hoisted on his own petard. So those of us who have been following the repo market, for example, following the secured overnight financing rate and a lot of different other indicators, it was painfully clear that the end of QT was coming and that Powell was essentially the market was going to force his hand, right? Because of this crazy ample reserve regime that the Fed insists on maintaining, because of the way that they have shifted away from a model of a reserve requirement and to a model of paying banks interest not to lend. The result is that whether the Fed wants to or not in terms of reducing the balance sheet, whether or not they want to use that to fight inflation, they can't now. Because it's going to cause another blow up of the repo market like we saw back in September of 2019. And if they let that go too long, you'd have a full-blown financial crisis. The Fed is not going to let us get anywhere near that point. They made the mistake once. They're not going to do it again. Now, the big downside here, of course, is that this is going to add a tremendous amount of inflationary pressure back into the economy. And the fact that you continue to keep trillions of dollars siloed in banks where it's not available to lend, that's really starving the private market for credit, and actually even the Treasury as well. It's pushing up yields on everything from your mortgage interest rate to your credit cards, and then also, again, Treasury yields. This is a big reason why Treasury yields have not come down. It's the monetary malfeasance at the Fed.
Mm-hmm. Yeah, you make a strong case that they're reacting to weakness. I mean, let's look at the vote itself. It was fractured in a way we've only seen 3 times since 1990. Governor Murin wanted a larger 50 basis point cut, while Kansas City President Schmid wanted no cut at all. I mean, does that historic three-way dissent really look like a coordinated plan to bail out Wall Street? I mean, does it paint a picture of a committee that's genuinely flying blind, as they call it?
Well, to a certain extent, I think a lot of the folks on the committee are indeed flying blind. I'm not sure it's really necessarily that it's painting a picture of any kind of coordination, whether that's a coordinated bailout of Wall Street or not. Rather, it's the framework that Powell and his associates have built that is ultimately going to force them into these bailouts for Wall Street. And let's make no mistake, they have been bailing out Wall Street for years now by paying literally hundreds of millions of dollars daily to these financial institutions for doing nothing, for not lending. I mean, it's the definition of a risk-free rate of return. And so, again, the consequence of this has been to starve the private market of credit. It's been to push up private market interest rates and to push down real growth rates. And we're starting to see some of the fruit of that in gold prices.
Yeah. Gold. We're going to talk about gold because obviously we've seen them on the rise, and it's just coming back to a little bit of $4,000 today on the spot side. You talked a little bit about those repo bills and the facilities which are soaking up trillions in excess cash. That's drained over 20 billion. I mean, the lowest level since the facility was created. The Fed's official line is that this is normalization, a kind of a planned move to maintain ample reserves, because if that plumbing starts to fail, the Fed doesn't just lose control of inflation, it loses control of the entire mechanism of monetary policy. Are you seeing a genuine liquidity crisis brewing in the funding markets right now, or is this an overinterpretation of technical adjustments that the Fed insists it has under control?
It's more so that this is the warning sign that we are heading towards one of those crises. But let's make no mistake, this is a crisis of the Fed's own making, and a crisis that the Fed could unwind if they so chose. But again, they are just so stuck on maintaining this new framework, and it is relatively new. I mean, it was basically instituted in 2020. The Fed was created in 1913. It existed for 100 years without these kinds of schemes. But they're so hell-bent, frankly, on maintaining this new way of conducting monetary policy that the market is going to just keep forcing their hand, because it will devolve into a financial crisis if they don't pivot like they just did. And make no mistake, the end of QT is just the first step. The second step is going to be a restart of QE, and that probably comes next year.
Oh my goodness, that'll be interesting. I want to bring up, we talked a little bit about Wall Street, but you and I, last time you were on the show, EJ, talked about Main Street's reality. I mean, when we spoke in August, you talked about the consumer being tapped out. I mean, the latest data seems to confirm that. What we're seeing in auto loan delinquencies at the highest level since 2010, and it's happening across all income groups. And according to the St. Louis Fed, credit card delinquencies for lower income households are up over 60% since 2021. Is the American consumer the canary in the coal mine that Washington and Wall Street are ignoring here?
Oh, certainly. And what's really scary is the number of canaries in the coal mine, so to speak. You can look at like commercial real estate. That's another market that I think is a really good example, where it is flashing warning signs. The alarm bells are going off, and just so few people are paying attention. And maybe part of the reason for that is because with a lot of these things, we've just been able to keep kicking the can down the road, whether that was bad monetary policy or bad fiscal policy. On the consumer end, we're just now really getting to the point where the consumer is tapped out and either is unwilling to take on additional debt, or the financial system is unwilling to provide that additional debt. And so this is where you're seeing the brakes come on pretty hard in a lot of areas of consumer spending. What's keeping it going, though, today is that you have roughly the top 10% of income earners are providing or are accounting, I should say, for half of consumer spending. I mean, that's incredibly lopsided. But the massive wealth gains, the massive increase in asset prices, whether those are equities or real estate, that has created a big wealth effect that has helped goose those consumer spending numbers for those upper income earners, which again is kind of keeping the whole thing going right now.
You warned for years about this whole everything bubble, right, that the Fed has created, and we're seeing this immense stress in regional banks. I have to ask you, I mean, it holds 44% of their loans in commercial real estate. You kind of brought this up. Delinquency rates on office properties are nearing 10.5%, and the industry faces that $1 trillion maturity wall of loans coming due. I mean, it's no longer a forecast. What is the correct policy response today? If Fed intervention is just another bailout that creates moral hazard, should policymakers stand aside and let market discipline run its course, even if it means some of these banks fail?
I mean, if there's any intervention on the part of Congress at this point, I think it should be to amend the Federal Reserve Act to limit how much the Fed can actually bail out these institutions, because the point you just brought up is exactly correct. And we can look back probably most recently to the spring of 2023, when we had that regional banking crisis with the collapse of SVB and others. And what did the Fed do? They stepped in and made good on all of this bad debt. And so it yet again reinforced this idea that if you get into trouble, the Fed and therefore the taxpayer is ultimately going to bail you out. And that's not the kind of system that we want to promote. Or I should say, it's not the kind of system we want to live under. It's not the kind of moral hazard that we want to promote.
Yeah, you brought up QE, and if we kind of go into that, I mean, they just brought up QT, but if we get into QE, I mean, it wouldn't be about stimulus; it would be more about survival, right? I mean, the Treasury needs buyers for nearly $2 trillion in new issuance, and the private market clearly isn't absorbing it at these yields. If the Fed steps back in, aren't we admitting that the U.S. can no longer finance itself without monetary inflation?
Well, I think that's been the case, though, for several years now.
Yeah,
I mean, how on earth did we fund so much of the debt that we issued the last 4 or 5 years? We just paid for it with inflation. We stole 20%, more than 20% of the value of everyone's dollars that existed in the entire world. That's how we paid for these trillions and trillions of dollars in spending that the government didn't have. And so it's just, I think, a continuation of that. Obviously, it's happening a lot slower today than it did in, let's say, the summer of 2022, but it is still ongoing, unfortunately. And it's one of the reasons why I think there's been such a movement into assets that the Federal Reserve or another central bank can't simply print. Whether that's gold, whether that's Bitcoin, whether that's real estate. I talked to some folks that they even do assets like cows, for example, and bulls. Those are their hard assets that can't be printed and that have gone up tremendously in value, that have seen that price appreciation. So that, I think, is going to continue. But one of the things that we're going to now see, I think, moving forward out of the Fed is this continued push to engage in yield curve control, to engage in the shift away from private market lending and to government lending. None of these things are good, unfortunately, in the long term, but that's what those are the directions that it looks like we're heading at the moment right now. And again, it's not simply that QT is stopping, it's that they're going to have to restart QE pretty soon, because they're trying to prop up the Treasury market. That's true. They're also trying to prop up bank reserves. And again, that means they're going to have to restart QE at some point if they're going to maintain the rest of the monetary framework that they've built since 2020.
So if that's where we're headed, I mean, isn't gold about to become the only truly independent asset left?
Yeah, I mean, again, at the end of the day, if it's something that the Fed can't print, then it sounds like a good investment these days, ultimately, because that is where you're seeing that devaluation. It's the Fed. It's going to be the Fed action of growing the balance sheet. And whether you're talking about gold, which obviously has probably the biggest monetary premium, or even something like silver that has a lesser monetary premium, you're going to see the same kind of appreciation there. And then again, if you start getting into the digital assets like Bitcoin, which, personally, it's a little too volatile for me, so I don't own any of it, but I understand people's fascination with it and their optimism in it, and why they attach that monetary premium to it as well. So again, the traditional things that have that monetary premium attached to it, gold being number one, I think that's going to be very, very bullish.
Gold's been reacting kind of conflicted. It's been interesting. It rallied on that rate cut, but it was beaten back after Powell's, hawkish talk and the China deal. What does that tell you? I mean, does it suggest that the market for now still has a degree of faith that the Fed can manage inflation and that, geopolitical risk can be contained?
Oh, sure. And look, at the end of the day, when it comes to gold, the only thing you get out of it is the inflation protection, right? Gold has such a high monetary premium attached to it that let's say that the uses of gold in terms of industry, it increases pretty dramatically. It won't actually affect the price that much, because gold is priced not just at its for its industry uses. It again has that monetary premium attached to it. So the price, the equilibrium is already much higher. So increasing that floor that you would get from the price of industrial use doesn't even really impact the price much, if at all. The consequence of that is that there's a bit of a cushion there, right? So you don't necessarily immediately see those moves unless you're looking at dollar devaluation.
Speaking of which, and it feels like a lot of this is trust based. I mean, where is that trust in the system right now?
It's a really, really good question, and here's where gold doesn't always move with the news, right? That, sorry if I sound like a broken record here, but that monetary premium is purely speculative in nature because today you don't use gold for exchange, right? I mean, maybe in extremely limited circumstances, but the dollar is still the law of the land. I mean, literally, you have to accept dollars, you go to jail. That's what legal tender laws are. So because there's so much speculation attached to that monetary premium, it means that as people's opinions change, as people's expectations on the future change, it can cause pretty dramatic swings in the price of gold. Let's not forget, I think it was back in autumn of 2022, the Wall Street Journal had a headline saying that gold as a safe haven is effectively dead, right? At the time, gold was, I think, $1,700 or $1,800 an ounce. Look where we are today. It has more than doubled since that ignominious headline in the Wall Street Journal.
Certainly. And of course, we're not seeing any central banks pausing purchases at these levels either. I got to ask you about, China, right? I mean, we just saw that major development with a temporary truce in the U.S.-China trade war. The U.S. is lowering tariffs, and in exchange, China is pausing its threatened restrictions on rare earth minerals and will resume some soybean purchases, making some farmers happy. EJ, I mean, you've been critical in the past, not necessarily of tariffs themselves, but of the strategy and the rollout. Looking at this deal, the U.S. has made some concessions, right? I mean, they cut the fentanyl-related tariff in half and bring in the overall average rate down to 10 percentage points. What does that tell you about the strategy here? And what are your thoughts about this whole meeting?
Well, I think a lot of the strategies here are working. People sometimes make the mistake when they look at how the Trump administration is using tariffs. They think that it's all the same, right? And you can't have that kind of myopic vision because in some instances, they're levying tariffs in certain cases to raise revenue. In other cases, they're basically trying to bully a nation like China into stopping the flow of fentanyl into the country that's killing hundreds of thousands of Americans every year. So it depends, right? Sometimes they're trying to protect industry. Other times they're trying to simply curb imports. For other reasons, maybe it's national security. And look, you can agree or disagree with that rationale. I'm not even trying to address that for the moment. What I'm simply saying here is that in the case of China, when it comes to something like fentanyl, the whole point of the tariffs was to get China to stop the flow of fentanyl. And they are pledging to get that down. And the result of that is that the Trump administration is now saying, okay, well, if you're going to fulfill your end of the bargain, so to speak, then we will as well. So we'll drop the tariffs. And in that sense, you can say that the tariffs, or at least the threat of tariffs, has been incredibly effective in getting China to play ball.
How advanced is China in some of these talks? I mean, if we look at those wins on the soybeans, Treasury Secretary Bessent announced a commitment for 12 million metric tons this year, 25 annually for the next 3. But some people believe that the U.S. is unlikely to ever regain its pre-war market share because China spent years successfully diversifying its supply chain to Brazil and Argentina. And then we got these rare earths. I mean, they still control over 90% of that processing capacity. So are we de-risking supply chains, or are we just deferring a next crisis? Where are we at?
Well, it depends. Again, if you're looking at something like the case of rare earths, where you have that 1 year pause, which, by the way, is really good for China too. I mean, they would have cut off their nose to spite their face if they had actually gone through with that. But what it does is it buys the rest of the world time. That's one of the keys here. It's not that there are no rare earths here in the United States or in Russia or in different parts of Africa and South America, but rather the issue is when it comes to rare earths is that you don't find them in concentration. So if, for example, you're mining for coal and you find a coal bed, it could be hundreds of feet thick and miles long. With rare earths, they are scattered. So you have to process a tremendous amount of material, and only a very small quantity of that is actually going to be the rare earths that you're after. Again, as opposed to coal, where you find a coal bed and it's just solid coal the whole way through. So with things like tax reform and regulatory reform, it makes it cost effective to get rare earths here in the United States. And you can very easily build up the infrastructure as well in a relatively short period of time to process that material. So what I'm getting at here is the fact that if you buy the United States enough time, we can actually reshore a lot of those critical supply chains relatively easily. Now, getting back to your questions on agriculture, you'll look the same things that gave American farmers a competitive advantage over places like Brazil. Those conditions still exist today. The only reason China went to other countries for things like soybeans or other agricultural products was essentially to try to punish the United States and gain leverage in the trade talks. So I see no reason why a lot of that would not revert back to the U.S. to help our export markets.
I got to ask you on that. We heard Powell talk a little bit about that data blackout, right? The BLS is offline, these key reports being delayed. I mean, you and I chatted last year about some of this data being not accurate. I mean, every single time I'd come to air, I'd have to talk about the real numbers a couple of months later. Just what does this mean for the markets? I mean, if the Fed, investors in the White House are all making these decisions without this real-time data, are we in a kind of policy vacuum? What are your thoughts?
Well, one of the things that happened before the government shutdown, which has prevented virtually any of these reports from going out, has been, just as you pointed out, horrendously inaccurate data. I mean, look, things need to be reasonably accurate, right? No one expects you to be dead on all the time, but these things have been so unreasonably inaccurate that it has forced private market participants, it has forced the Federal Reserve to look for alternatives. I mean, this is not just me complaining about the data. This is every major Wall Street commercial bank, investment bank complaining about data in the post-pandemic world because of how much the quality has deteriorated. And as a result, for several years now, people have been developing alternative sources for data. People have been looking at other indicators than the official government metrics. And even when the official government metrics came out, very oftentimes people would check them against the alternatives to get a sense of, is this actually reliable, or do we need to take this with a huge grain of salt? With the government shutdown being in place and those government data being unavailable, people seem to be doing just fine looking at a lot of the alternatives. And that was something that even Jerome Powell pointed out in the recent press conference, where he said, look, we have the 12 district banks. Every single one of them is doing economic surveys, typically of businesses and consumers, sometimes one or the other. And from all of that, we're also getting a sense of where the economy is right now and where it's headed. So, maybe we're getting to a point where if the government statistics don't get better, no one's going to pay any attention to them at all.
Yeah. I was going to ask you, I mean, what would a reformed data regime look like that kind of restores that real transparency and credibility? I mean, if we get a new Fed leadership next year, what's the model you'd want to see? One that kind of prioritizes better data before policy? Because right now, I mean, it feels that the Fed's flying off stale or revised information.
Absolutely. I mean, in terms of the Bureau of Labor Statistics, there's a whole lot you can do with public-private partnerships. They do it in a very limited sense already. If you look at where they get data, price data for gasoline, for new car prices, for medical care services and commodities, a lot of that data actually comes from private sources that the agency contracts with. But you can really expand that. You can contract with major brick and mortar and e-retailers like Walmart, like Amazon, who have the prices for just about everything. And via those mechanisms, you can get real-time price data, and you can greatly expand the number of observations you have of the data. It increases accuracy. You can do the exact same thing with the payroll reports, where you contract with major payroll processing companies like Gusto, like ADP, like Paychex, that's Paychex, and you can get all of that raw data in to get a sense of which direction the economy is going, where things are today, right? Right now, the BLS basically surveys less than 2% of businesses each month. Fewer than half of those surveyed respond. So you get data on less than 1%, and you're trying to figure out what the other 99% are doing. I mean, that's just one example of why the numbers have been so inaccurate. And then as far as the Federal Reserve goes, once you get the better data coming in, you sure as heck better be data dependent. One of the things that we've seen from Powell and company has been kind of this refrain they keep saying on how they are politically independent and data dependent. Frankly, they are neither. We have seen plenty of times when the data clearly indicate they should move one way or another on the interest rate, on their balance sheet, on regulatory policy, and they do exactly the opposite.
Well, I think what Jerome Powell's term is over in May of 2026. I mean, you made the case for rebuilding trust in the data. That raises the next question about leadership. I mean, if transparency and credibility are the new battlegrounds, the Fed's next chair will have to be more than a rate setter. I mean, they're going to have to kind of be a reformer, no? Who do you think fits that role? Is there anyone on the horizon who understands both the plumbing in the system and also the public's loss and faith in it?
It's a really good question. I mean, Kevin Warsh jumps out. I think he would do a really, really good job. When you hear him talk about the Fed, he realizes that there has been this hyper focusing on the financial plumbing where, again, the Fed is trying to maintain this artificial framework that they've just built over the last few years, which clearly isn't working, but they refuse to unwind it. They refuse to let it go, and they refuse to get back to normal. We're talking basic things here, like just simply having a reserve ratio where banks have to keep a certain percentage in reserve at the Fed. Very basic. That's been part of monetary policy for hundreds of years. It was part of it was really the entirety of the Fed's existence until the spring of 2020. And so we've seen the last several years a lot of these monetary experiments that have failed. They haven't worked. They haven't delivered stable prices. They haven't delivered stable interest rates, and they have not contributed to full employment. There's no reason to continue doing them. Kevin Warsh, I think, understands a lot of that. And he's also an inflation hawk. And I think he would do a tremendous amount of good to bring back not only price stability, but allow a lot of the loanable funds market to go back into private hands and not just simply be under lock and key at the Fed.
Yeah, I mean, do we need more of a Volcker style kind of disciplinarian again, or somebody kind of re-engineers how the Fed measures and communicates reality itself? I mean, Warsh, if he takes the helm, he's been arguing for data reform, tighter balances, sheet discipline, of course, restoring Fed's independence. Could he realistically get it done? And what would that mean for a gold investor?
I think it'd be a tremendous asset for anybody, not just gold investors. Look, again, going back to something we touched on earlier with gold, when it comes to inflation, you don't actually make money on gold. You don't lose anything. Right? If you put your money into equities and equities outperform inflation, yes, you have done better than inflation. Of course, you're going to have to pay tax in most instances on all of that, including the paper gains from inflation, not just the real gains. So if you're looking to beat inflation, you need very, very aggressive investments typically. You need to take on a whole lot of risk in order to outrun that beast. What gold does is it perfectly protects you, right? There's no doubt about that. But it's not something where you're going to see, again, that significant price appreciation because of that monetary premium being so far above the industrial uses price floor. Again, we kind of mentioned this earlier. So for the gold investor, if you actually get back to stable prices, what that allows you to do is not have to solely rely on something like gold for so much inflationary protection. It allows you to diversify and actually get a higher real rate of return. Look, I love gold. Trust me, I'm a big gold bug. I would even love us to get back to a point where we actually have our currency backed by gold. But all that to say, whether our currency is backed by gold or backed by some other asset or just it's just pure discretionary monetary policy, I still want stable prices at the end of the day because that's going to be the best thing for everybody.
Watching the markets, before I let you go, I mean, on the general markets, I mean, even at rates still about 4%, equity valuations haven't cracked. I mean, the S&P 500 trading around 21 times forward earnings, and the tech is a near dot-com industry, as you kind of know. If the Fed's already easing and liquidity is creeping back in, is the bubble still very much alive, or have markets just stopped caring about the fundamentals here?
Well, one of the things that we've seen recently has been a pretty tight correlation. There's been some deviation at key points when you have a unique outside influence, but there tends to be a pretty tight correlation between equities and bank reserves. And the whole reason that the Fed has stopped QT and is going to restart QE in the coming months probably is because they want to get bank reserves back up. They want to start increasing bank reserves, especially if we continue to see economic growth, especially if other parts of banks' balance sheets continue to grow. Because the key that the Fed is trying to, the key thing to understand here with the Fed is they want bank reserves to be maintained in a certain ratio relative to other things. So if you're looking at, again, bank reserves to GDP, for example, if GDP keeps growing, what do you have to do to bank reserves? You have to keep pushing them up. And so as you increase those bank reserves, you would expect to continue to see a bull market in equities as well.
That's a central bank caught in a loop. I mean, how do you ever restore the balance sheet discipline if every attempt to tighten ends up depleting reserves and forcing another easing event?
You don't. And see, that's the whole problem with this artificial monetary framework that they built starting in really, I guess, March of 2020. And it even technically precedes that because they were paying interest not on all reserves, but at least on excess reserves going all the way back to Bernanke. And so when they were drawing down the balance sheet in 2017, 18, 19, it caused a crisis in the repo market in the fall of 2019. And the Fed briefly lost control of interest rates, actually, for a couple of days in September of that year, if I remember correctly. And they had to reverse the QT and flip to QE. And that was even, before COVID started. But then they really blew everything up, obviously, in 2020. And so if they're going to be so hell-bent on maintaining this new framework, you're right. There is no way that they can unwind this. There is no way that they can ever return the balance sheet to normal. And that's a big reason why, getting back to your leadership question, it is so important that you get somebody like a Kevin Warsh in there who understands you do need to radically change this framework. It's not sustainable.
Yeah. So, I mean, is it really about stabilizing reserves, or is it about keeping the financial markets artificially supported? I mean, these are the questions, right? At what point do we call this what it is, permanent monetization dressed up as policy management?
Well, I think the gold market has been calling it that all year.
Yeah.
Hence the huge run up that we've had, right? It's not just central banks buying gold. Yes, that's obviously a big part of it, right? That's been a huge part of it. When gold hit what is now the low of the decade at that point, central banks went on a total buying spree. And that was due in part to the United States making the very wrong-headed move of confiscating those Russian dollar-denominated assets. That has told everyone, it has broadcast a very clear signal: your dollar assets are no longer safe, even if you own them. Even if they're not owned by the United States, they still might not be safe. And so you're better off in something like gold. Yes, that has had a huge impact on the market. But I think a lot of what we've seen this year, not all, but a lot of it, has been people's increasing realization of where we've already been and where the dollar continues to be headed.
Yeah, well said. All right, Dr. E.J. Antoni, your perspective is always crucial. Check on the consensus here. I want to thank you for your time. Appreciate you making it today.
Oh, my pleasure. Thank you for having me.
Yeah, of course. And we hope to see you soon. Of course, we're going to keep tracking the Fed, gold, and the fallout from the U.S.-China trade truce right here on Kitco News. It's all the time we have for today. I'm Jeremy Szafron. We'll see you next time.